Hi everyone, this is Finance Meets Real Estate. We meet here every Tuesday, 6:30 p.m. Eastern Standard Time. We have incredible guests every week, such as our guest tonight. We've had over 100 guests so far on this webinar, and we are a YouTube channel, so make sure to check us out, Finance Meets Real Estate on YouTube. Today, we're going to talk about acquiring 150 million in multifamily with a W-2 job. So our guest is Elijah Brown. So he's the founder of Gold Coast Capital. He previously worked for a large real estate investment trust. And as an employee during the day, he would work nights, weekends, every available minute he had, sourcing his own deals, raising capital outside of his work. Used the skills from his job, and he was able to grow his portfolio. So now he has an interest in nearly 1,000 units worth over 150 million. He's financially free. So it's an incredible story. I'm very excited for tonight. And so Elijah, he also earned his bachelor's in business from the University of Southern California. And we just had a conversation about he currently is a full-time traveler, right, Elijah? So you full-time travel.
That's right.
Work remotely.
Yep.
You're currently in Mexico, traveling yourself and working from there. And so with that, I'm going to pass it on to you. I'm sure we're going to have a great presentation. If you guys have any questions, feel free to put them on the chat, and we'll open up for a Q&A at the end.
I appreciate it, Stefan. Thank you for having me on, and everybody. It's really a pleasure to meet you guys and have the opportunity to tell my story and how I got here to the beach in Mexico. I'm currently living full-time out of a converted Mercedes Sprinter van, and I'm here with my girlfriend. We took 2 years to build the van out, and now we're finally we're traveling. We go beach to beach, so we spend 4 to 5 days at one location, and then we pack up and we go to the next one. And it's just been an incredible experience, and I wouldn't have been able to do any of it without the real estate investing. And so I'd like to tell you guys my story, and rather than just tell you, I have prepared a few photos to accompany my my lecture. So let me know once you can see, and I'll turn on the play from beginning.
Yeah,
can you guys see the screen?
On my side, it's perfect. So I think you're good.
Yeah. So it's funny because it's got $150 million worth of real estate, but I don't own all of that. That's not my $150 million. And so I own a portion of it, probably like 1% or so, but I will explain to you guys how I got there, how I started off, just as a broke college student, and now I'm living at the beach. And it's funny, I actually had 2 W-2 jobs at the same time. It wasn't just that one job at the REIT, but we'll get into that. So it all started off, I got to college and couldn't afford it. So at my sister's recommendation, I walked down to the ROTC office. That's the military. And I said, what do you guys got for me? And they wrote me a full tuition scholarship check for 4 years and said, here's $350,000. You are going to work, and then you're going to owe us 8 years once you graduate. And so I immediately signed, not wanting to take on that much debt, and began doing ROTC. And while I was at school, I picked up a number of part-time jobs as well. So I had my school paid for from the military, and then I was working really hard as well, trying to just save as much money as possible. Here's another shot from my time in the Army. I'm still in, by the way. I'm in we call it the reserves. So it's a part-time commitment of 1 weekend per month, and different units do it at different times. But I'm about 5 years into that 8-year contract. And while I was in school, I had saved up enough money to come up with about $10,000, which was not nearly enough for a down payment on a house. So I reached out to my best friend Larry and my cousin Jake, and they agreed to put up the rest of the money. So we somehow came up with $40,000, and we were living in Los Angeles, and we ended up buying a house in Orlando, Florida. And this was that first house on Kingfish Drive. So we were still in college, and we put a tenant in, and it went so well, and we loved the process. That was a bit sarcastic because it was definitely not easy at all. There were a lot of roadblocks, but we got through them, and we saw how powerful real estate investment could be. And so we did it over and over and over again within the single family space. And then I graduated and I commissioned into the Army. There's my girlfriend there on the left. She's still with me today. And that was an awesome experience. But then I needed to go find a job because my real estate investing had not yet made me financially free. So I needed to find a way to make additional income so that I could keep investing in deals. And so I'd say, and I want to kind of give you a little bit of a framework while I'm going through my story. So, like, step number one, do everything you can to like get out of debt, or don't start out with a lot of bad debt. So I joined the military so that I wouldn't have to go into debt. It's a bit extreme of an example, but there are a lot of different, ways that you can do it. But also just get started. I went out, I watched 2 weeks worth of YouTube videos and just started buying properties. I found the people to do it because to come up with the money, because I didn't have it myself, and we just went out and got started. We made a lot of mistakes. Number three is to get a job in the industry that you want to be successful in. And so I went and found a real estate investment trust to work at, and I applied to a lot of places, and this one accepted me. And there's my first day on the job. My boss was out at lunch, and I took the opportunity to go put my feet up on his desk. So it was a little bit of foreshadowing for my life as someone who doesn't like to conform to typical rules and corporate structures. So that was my first day on the job at Health Peak. And there is the saddest face of my life. That's me in my cubicle during the day with my headset on, working as an analyst. Felt like a slave. And on the right, there is where I started building my real estate portfolio in my first apartment. Well, after a little while, I had a mentor at the company, and he convinced me that scaling into multifamily rather than just single family properties was the best possible decision I could make for a lot of different reasons. And so I started looking, I hired brokers and started underwriting properties. And I finally found this beautiful sixplex in DeLand, Florida. And it was just horrible. It was really bad. And she was not happy. That's one of the tenants right there. And she did not want us touring her property. So I bought it. There's me with the little selfie in the mirror. And that was my first multifamily property. And that was a big step for me. I had to raise $112,000 as the equity in the deal. And that was one of the hardest things that I had to do. I went around to all of my coworkers on the floor at work, all the analysts, all my friends, my family members, and I was raising $5,000 to $10,000 from each of them. And I barely came up with the money. I even had a shortfall a week before closing. One of my investors completely backed out, and I had to go frantically meet up with the seller at some random hotel and beg him for $20,000 of seller financing, and he agreed. So we bought that property, and that property had a ton of issues. It was an old 1948 build and just had a lot of problems, but we renovated it. We got through it, and we dealt with all the problems. And this property, we held it for about 3 years, and it produced over a 50% IRR for our investors. So it was very good. We were able to take the money from that first sale and reinvest it into other buildings. And then the Army called me back and said, hold on, I know you've got a job and that you're trying to build a real estate portfolio, but we want you. So, and when the army calls and Uncle Sam rings his bell, you drop everything and you go. So I went to a school for 6 months. Not that I had a choice, but I just couldn't shake the deal bug. I had to be doing deals. And so, oh, that's my friends and I. Looks like Brokeback Mountain, but so we went out and bought a property in Arizona where my army training was. And this was our second multifamily property. It was a 5-unit. And we renovated it, bought it, renovated it, and we sold that one as well. And it went very well. And so I'd say something that's really important in the beginning with your first few properties, it's like spend a lot of effort and make sure that those go well because it's the foundation of your track record. If you screw up on the first few deals, then nobody's going to trust you on more deals. So it's really important to make sure that those first few ones work. And I don't like to take really all the credit for how well these deals performed. The reality is that I was investing in a very hot market. Property values shot through the roof, and perhaps we should have lost money on a few of those single families, but we ended up doing well. Those single family properties were averaging 30% IRR on the exits. So we just kept doing it over and over again because we found a formula that worked. We found good contractors, we had a broker, we had relationships in our markets, and we renovated. And we did a really good job on the renovations. And it was scary because we spent a lot more on our renovations than most people do. And we knew that it was very expensive, but we also knew that it was going to be worth it when it came to sell, and it worked. So we did it over and over and over again. Here's some of our smaller multifamilies. And then something clicked. We wanted to grow exponentially, but we realized that doing all the work ourselves as the main general partner on these deals, it was just way too much. I was going and making relationships with brokers, sourcing properties, arranging the debt, finding the investors, doing, managing the manager. It was just a lot of work, and we wanted to scale. And so the way we did that was by partnering with much larger companies to be able to do that. And so that's kind of the next step in the process. Take what you're good at. And for me, that was making relationships with investors and underwriting deals, bring that value to a larger team, and take a smaller portion of the deal so that you can grow the portfolio and focus on what you're good at. So we did that a number of times. And this is where we really started to achieve scale. We bought the portfolio in Vermont, Colorado, Arizona, Georgia, and we just kept doing that. And then we started thinking, well, these deals are going well. We've had a lot of deals go full cycle. At this point, I've had about 9 deals go full cycle. We're averaging between like 30 and 100% IRRs on those. And we made a little bit of money, and it was great. And we started thinking, what do we really want to do with our lives? What's going to make us happy? And for my girlfriend and I, that was traveling. And we saw this picture of this school bus and the interior of it. And it looked really luxurious. It was like glamping, but like you could take your house with you wherever you wanted to go. And so we were very inspired, and we bought a van. This is the Mercedes Sprinter van that I'm currently sitting in. And we took 2 years to renovate it. I'd like to show you some of the before and after pictures and midway through. And this is what it looks like today. And I kind of show you guys here, but the pictures are a lot better than my camera on Zoom. So this is what it looks like today. And we're very thankful that it came out well because we had no construction experience. I could not even cut a straight line. My girlfriend was a lot better with power tools than I was. So here's a few more pictures. We've got solar panels on the roof. And the reason we're able to work is because we have Starlink. So you'll see on the roof here, we've got one of Elon Musk's Starlink satellites, and actually everybody has them. And this is just one of the beaches that we've parked at, but we're able to get internet anywhere. And so I didn't want to stop working. And so I needed to adapt my business model to my lifestyle. And so instead of doing active deals, right now I'm focused on primarily being a passive investor myself with my capital, but also inviting other passive investors to partner with me on opportunities that I like and that I've underwritten and that I've done due diligence on. Because instead of writing a $50,000 or $100,000 check for these deals, together we can write a $2 to $5 million check or more. And with that type of equity, we have a lot of negotiating power. We can go to these sponsors of these deals that I like, and I can say, instead of a 50-50 profit split and an 8% preferred return, I would like a 90-10 split and a 9 or a 10% preferred return. And when you write a large check, as Ethan Gao knows, see him over there, you can get negotiating power and you can get terms that you like in the deals. And so that's what we started focusing on and doing. And right now, my entire job is making relationships with other people like me who want to invest their money in good deals, but want to do it collectively so that we can negotiate better terms. And here's just a few pictures. A few weeks ago, I went paramotoring. We actually had an emergency landing on the beach. It was very exciting because the LeBlanc Spa and Resort in Cabo was right there, and so I just walked right into the pool area, laid down and had a drink while the guy fixed the paramotor. And it's not all flowers and roses here. Occasionally, I do have to fly back to reality to do my job, and so this is a picture of me at the Best Ever conference a few weeks ago in Salt Lake City, because I still work in the real estate industry. And I met these two guys. This is Sam and Seif, and they run one of the first institutional investment opportunities in the Airbnb market, which is really cool. Their company TechVestor is going out and buying 100 Airbnbs. They already have 75 of them across 10 different states. And I've always wanted to get into Airbnbs because to me, they're similar to multifamily in that they're diversified. You've got multiple families, but the yield is much higher, and it's higher risk, but it's also higher yield. And that was very attractive to me, and the quality of their properties. And so I decided that I was going to invest money in these guys. So I flew out there, I met them. We had multiple meetings and dinners, and decided to start a pool of capital for investing in this really cool Airbnb opportunity. So that's what I'm focused on right now, at least for the next month or two. And I am looking for partners, of anybody who is interested in getting in on some high cash flowing Airbnbs. The cash on cash is projected to be between 8 and 12%, with the goal of doubling your money within a 4 to 6 year time period. So this is what I'm focused on right now. And if you're interested, please reach out. You can shoot me a text at 802-345-2213. And I hope that you guys liked my story and my presentation. I'm happy to answer any questions.
That was amazing, Elijah. Thanks for the summary. And so in terms of, I was just curious, in terms of like switching to the multifamily space, and you went through that quite a bit, but the motivation sounds like was, if you're the primary GP on a deal, it's like a ton of work. And so you want to kind of like get a more specialized role, be it in kind of like capital raising and underwriting a deal and kind of like getting other passive investors onto it and having negotiating power with the pool of capital for that. And that worked better for you in terms of kind of your lifestyle design and being able to travel and so forth. Is that the motivation, or what was your primary motivation for?
Yeah, at first, it was the theory that if I can just focus on what I'm best at and be really good at that and bring that value, then I'll get a lot further, rather than running around like a chicken with my head cut off, trying to do every single job and do it half-ass. So that was the primary motivation. The secondary motivation was, yeah, my lifestyle now. I am not going to be managing a contractor, from Mexico. I can't be at the property every other day to do that. And also, I don't want right now to invest my time in getting dinners and lunches and coffees with brokers to try to get those deal flow. So right now, I'm just focused on, let me just be primarily a passive investor to invest my own capital in opportunities that I like with great sponsors with good track records. And then to be able to do that with better terms, I want to do it with other people. So that those are the motivations.
Right. That I think that makes a lot of sense, and it's actually achievable in multifamily, right? So, which is a great thing. So you could actually fully, do nothing with regards to the physical property. You can just kind of raise capital, let's say, or do other specific functions. And so, yeah. So, Christian, go ahead.
Oh, you're on mute, Kristen. Stefan, I think she's on mute.
Hold on. Yeah, if you don't mind just unmuting, Kristen. Yeah, I think no, it's still on mute. Still on mute, sorry.
Is it like a mute function that you've muted everybody?
Yeah, no, I tried. I pressed on like ask to unmute, but I still think you need to do something, Kristen. Actually, I just pressed ask to unmute. No. Why don't we'll take the next person and then try to, you can unmute yourself anytime. You can unmute anytime and we'll be able to take your question. Yeah, sounds good. All right, Scott, go ahead.
Hey, can you hear me?
Yes.
Yeah.
All right, sweet. First of all, awesome story, Elijah. That was so motivational. I love the van life. Like my wife and I geek out on those videos on YouTube. So to see that,
Thanks,
like,
man.
that's what you're doing is so cool. Anyways, I'm curious about the fundraising, like the money raising side of your business. I've been flipping houses and building houses for 10 years, but I've never done that like kind of crowdfunding that it sounds like you're doing. So could you just speak to like how you got started in that, and like what your outreach was like where did you go to find people who were interested in investing with you?
It's funny because most people, when they get started, they just go out and they use their own primary residence, turn it into a rental, or they go and they buy their own rental with their significant other or whatever. I started syndicating from day one. Syndication just means the pooling of capital from multiple people. And I did it because I needed to. I didn't have the cash to get into these deals. And so I had to bring partners on board to do it. And, at the time, I didn't really know what I was doing. This was 7 years ago. And, I didn't realize all the, the regulations and, the different types of exemptions available. I was just getting together with my friend and my cousin. We were just going out and buying properties. And then I read a book called Raising Private Capital by Matt Faircloth. And that kind of alerted me to, wow, there's this whole world of people like putting deliberate structures together to essentially, sell as many equity shares in a property as possible. And there are whole frameworks of regulations and exemptions and stuff from the Securities and Exchange Commission that you need to follow to do it legally. And I started going down that rabbit hole. But I've partnered with other people on every single opportunity. Using other people's money is a great way to get into more and larger deals.
What's your primary way for, I guess, lead generation for that, Elijah? Is it, I know for some people it's maybe their podcasts, or they keep posting on social media, like consistent social media posting, or like what What is one?
Yeah, it's a good
Yeah.
question. It all started out with like friends and family. So you go to the people who are going to trust you and you don't have a track record first. You got to make sure, you usually got to have your own skin in the game. But when you don't have enough skin in the game, the only people who will trust you are your close friends and your family members. So you start there. That's what I did. And then I branched out to coworkers and people that were like within my sphere. And the deals went so well that like I had 40 of those and 40 people, and they're all like repeat investors because the deal was going well. So I just kept rolling their funds into other deals. And so I went 6 years without needing to raise retail equity from regular like investors on the internet. Fast forward to today, when I'm looking at much bigger opportunities, I need to reach out, and as Ethan says it, I need to shake the booty on LinkedIn. And so now I'm primarily using LinkedIn as my main avenue for connecting with people and establishing relationships with new investors. People who are professional and want to network with other professionals are typically on LinkedIn. There's a very high engagement rate there, and so it's a good place to do that. And you can target, the demographic that you want to reach.
So LinkedIn is kind of your main, at least prospectively, kind of where you're looking to focus more in the future.
LinkedIn, word of mouth is still there, but LinkedIn is the primary now. And the whole point of engaging on LinkedIn, there needs to be a call to action, whether that's getting people into your like educational email sequences or getting them onto your email list, or downloading like a digital knowledge product like an ebook that provides value. You just got to like provide tremendous value to people in exchange for their contact information, so that when you do have a deal, you can send it to them. And that's important. And once you have their contact information, you can start building a relationship. Most investors will not invest money the first time you send them a deal. It sometimes takes 2 or 3 or even a full cycle deal before they'll invest their cash with you. So you got to get them in early and start showing them the returns.
So what does your kind of, let's say, your work day look like now? Basically Zoom calls with
I
with
try to
people.
maintain some degree of consistency with my schedule. I usually wake up at 4 a.m. to the cat bouncing off the wall, and I try to fall asleep. And then, I start my work day around 7. I'll typically work until around noon or 1. I'll have lunch, and then I'll try to relax and enjoy where I'm at. And that's Monday through Friday. Saturday and Sunday, I'm just exploring and enjoying. I mean, I live on beaches in Mexico. I need to have fun while I'm here. So
no, that's awesome.
Yeah.
That's great. That's very, very inspirational, actually. Like Scott mentioned, that's really great.
Appreciate it.
I don't know if you follow like Maurice Fuegin on LinkedIn.
I might.
He's been at this webinar. You can check him out, like Maurice Fuegin. So he's pretty big on like lifestyle design, and I think he travels as he does like multifamily deals and things like that. So might be a good other comparison point, or for extra additional inspiration. And so Kristen, do you want to try now unmuting? Let's give it one more shot, I guess. Maybe for some reason it looks like it's not doable. Okay. Well, we have a question on the chat from Cedric. So he's asking, have you been able to get any military investors to invest in any of your deals? And actually, Kristen, if you want, maybe you can just put your question on the chat and I will relay it. Let's do that.
The answer is yes, but none through like online connecting. It's been mostly like people that I've met at different like military schools or trainings that I've established like deep long-term relationships with through those trainings. And then one of the issues with syndicating deals, a lot of the most of the deals that I've done in the past have been 506Bs, which allows me to accept non-accredited investors. Most people you find in the military are not accredited. They simply don't make enough money to qualify, and their net worth is not $1 million or more. But I do have a few of those friends who have been very successful, specifically ones that utilize their VA loan early and keep using their VA loan every year to buy a new house. Those people have become accredited, and some of them have invested in my deals.
Mhm.
The 506B deals, I am now transitioning to doing 506C deals. Those allow me to advertise, but I can only accept accredited investors on those deals. But it's getting to the point. An attorney told me recently, he's like, you really only want to be working with accredited investors at this point, just because if something happens, the SEC decides to crack down, the fact that you are, accepting money from, people who are not accredited and may not be sophisticated or even understand what they're getting involved in, that can be a very dangerous situation. And if you don't have the evidence to show that you've established a very significant, pre-existing relationship, then you can find yourself in trouble.
Mhm. In terms of underwriting, like those deals from other, let's say experienced operators, and I'm gonna take the other question from PJ after, but like what is your approach? Because it's not super easy to underwrite other people's deals, right? It takes more conversations, kind of going deeper to actually understand what's going on a qualitative level, right? Like
it's a
besides the
lot
numbers.
less.
Yeah.
It's a lot less about the underwriting than it is about the actual person, the sponsor that you're investing in. Like, first and foremost, like you need to trust the sponsor. You need to establish a strong relationship with them. For me, I want my sponsors to be like independently wealthy. I want someone who's not going to do capital calls. I don't want them to be able to do capital calls at all after the initial one. And I want them to be able to save the day if something goes wrong. I want someone who can write a $10 million check if they need to save the deal. So that's like what I first look for. Do I trust them? Do they have a good track record? Because if they've done 10 or 15 deals full cycle, they have some experience. And, if those deals have gone well, then that it's likely, it's not guaranteed, of course, but it's likely that they will do well on a future deal, especially if they have done full cycle deals through a recession. So a sponsor who has been through the 2008 financial crisis or something, and not saying like that those are, it's harder to find those now because there are so many new syndicators, but those are just some of the things I look for. Obviously, like underwriting, there's a lot of red flags to look for, expense ratios, fees, different types of things that you'd want to, just make sure are squared away.
And in terms of markets, let's say, do you have any markets that you kind of exclude now? In the event we might enter a recession in the future, let's say, like, do you have like certain markets that are kind of, okay,
it's funny. So
yeah,
I really won't buy properties in blue states. And I know it's just one of those things where it's not worth risking a politically unfavorable environment with how much money is at risk. But I really like places like Arizona, Texas, Florida, the markets where people are moving to.
Okay. So actually, let's get PJ. PJ, go ahead.
Wait, can y'all hear me clearly?
Yes.
Yeah.
Wonderful. Brother, thank you so much for just taking time today. A lot of the terms that you mentioned today, obviously I need to read books to really understand a bit deeper. But just to kind of give my story and just to get your perspective, if I'm on the right track. So I'm a W-2 employee in tech in one of those blue states, which is California. And
that was me.
Yeah, man. I guess the next step is like I'm about to get married in December. So it's just a lot of big steps and trying to plan for the future. And one thing the gal and I were thinking was, why don't we get a conventional loan on a duplex? We live on one side of it, rent the other, and then kind of just start to build our empire as a team from the start of that house in California where we do want to reside. I guess one, is that a good option, or what do you recommend from your
It's a
experience?
fantastic idea. I think the best way to get rich initially is to do a live and flip house hack, which is what you're talking about. You're talking about buying a property, maybe doing some renovations to fix it up, living on one side, renting out the other, and
Correct.
essentially that tenant helps you pay your mortgage. That's a fantastic way to get started. I would absolutely do that if you can, but make sure that the numbers work out first. Don't just jump into it. Like if, make sure that it makes sense and that you're not going to spend way too much on the renovations to be worth it. So.
Yeah, we're looking for some nice turnkey ones. And then I guess my big question too is, if someone like myself is very interested in this kind of avenue of life of multifamily, how does one who's not really able to kind of go into, like, as you're mentioning in the story, like you took a job within the industry that you were interested in. I don't really have that luxury in the current discipline that I am in. So how does one find a mentor to really get that inspiration?
PJ, I think for 99% of people, I would recommend, because I went down this path for 7 years, I'd recommend not trying to do it yourself. Honestly, I would recommend starting off by trying to passively invest in someone else's deal or bringing some type of value to their deal as a co-GP. But like, I wouldn't just jump off and do it yourself. I would try to invest alongside someone else so that you can learn and see all the mistakes that are made and understand what you have to do to be successful. So I would look for a good sponsor, or I would look for someone else who's done this a lot of times before that you can partner with.
I appreciate that, bro. Thank you so much, man.
Yeah.
Okay, so Kristen, Kristen is able to unmute. So go ahead.
Yes.
All right.
You got it.
Thanks.
You
Thanks
guys
so
are great.
much. Thanks so much. I kind of fell into this meetup, so I really appreciate, your story, and I'm so glad I did. I'm also in California. A little bit of a different situation with me. I just find myself very fascinated by real estate. I purchased a condominium here in California in 2021, and looked at the meetup and thought, well, this is interesting, and you surpassed my expectations. So great story.
Thank
and
you. Appreciate it.
and moderating and helping me unmute. Thank you, guys. My question I get, or I have so many, and hopefully I'll be able to hook up on LinkedIn or talk to you offline if I'd like to. It sounds very interesting. What you're doing. Do you have a real estate license? Do you find that that's necessary?
Nope, not at all. It's not necessary. And in fact, I don't get one because I like to rely on the professionals who have them to find me deals.
Okay.
And it's not necessary for raising money. There are realms that you could get into once you're raising capital for a fund and a blind fund, and there's a whole different rabbit hole that you can go down where you would need some type of license to legally be able to raise money and operate deals. But I'm not at that point, and I don't need any kind of license for what I do.
Understood. Okay. And if let's say, great, I'm interested, I speak to you, I've got some money. And I apologize because this is like really like just like so basic for me, but your investors are getting a piece of it. They can expect their money. You mentioned maybe, in how long could they maybe get their return? If
it depends on the deal. So
okay.
You'll see deals anywhere from 1 year long up to 20+ years with no intended exit. They're just cash flow opportunities. So my deals typically fall within the 5 to 7 year range. Although I'll caveat that by saying we have exited most of our deals much faster than that because the market did so well. And when you can give your investors a significant rate of return,
Right.
you kind of have a responsibility to do that. And so that some of our deals we've gone full cycle in 2 years. So.
Okay, great. And how does, if I can just throw in one last question, but how
No,
is
sure.
this Airbnb investing working? What is it that you're buying from Airbnb? You're
So
buying
we're not
properties that are going to become Airbnbs?
correct.
Okay.
So we're what's great about this opportunity, the founders, the operators of the fund, they come from a software engineering background at big tech companies. So they wrote software and algorithms to scour the market using various APIs to essentially identify the best properties for acquisition. And these are just regular single family homes, just like you'd sell your home. But they happen to be in a market that we've identified is a very good market for Airbnb. And so, we'll go out and we'll buy 100 of those properties. We do
Okay.
renovations. We furnish them. So you buy the property and a couple months later, it's listed on Airbnb getting, $400 to $1,000 a night. And,
Got it.
it starts cash flowing. And we've got a whole in-house team of property managers as well. So that's it.
And Gold Hot Capital is you, or is your
Gold
company?
Hot Capital is my company, and
Okay.
I am essentially raising a pool of capital. I'm looking to partner with other passive investors so that we can together invest in this opportunity. And because we're able to
Understood.
put our money in a pool together, we can negotiate much better terms. And I also have the managers of the deal on speed dial, and I can get them to do anything I want by shooting a text message. So that's one of the other benefits.
What does it mean by passive investors?
It means we're not participating in the decision making. Essentially, we're not
Okay.
doing anything. We write a check and we collect our dividends. And if we write a large enough check, we can get a bigger piece of the deal.
Got it.
Yep.
Thank you.
Mm-hmm.
So, Brandon, go ahead.
Thanks, Stefan. Good to see you again. Elijah, I appreciate you sharing your story. It's just awesome to see that you started really young, and also that you're just doing this on your own terms and you're helping a lot of people retire early.
Appreciate that.
Very inspiring. Just quick background. I'm 26. I live in New York. I've been in tech sales for 4 years now, trying to branch out into real estate, helping a friend who's been in real estate for a while facilitate basically like commercial real estate deals in South Carolina. I just started on that. So just kind of starting on this real estate journey. But one question I had for you, I also have a lot of questions similar to Kristen, but I'll boil down to one. If you could go back to 7 years or 6 to 7 years ago when you first started in real estate, what is one thing that you'd wish you'd known then that you know now?
There are a lot of things that I wish I knew. But I think it's the same answer as one of the previous questions, is that I didn't realize I didn't have to do it all myself. I didn't know there was this whole world out there of like people putting deals together, people who are good at putting deals together and have done it before. I went out and just started, swinging my hammer and trying to do deals. I think I would have tried to partner first, maybe as a passive investor on a few deals, and then trying to offer some type of value for a co-GP position, which is like a managerial position in one of those opportunities. So that's what I would have done. I would have started off by probably going straight into like 100+ unit apartment buildings or like 100+ property portfolios, but like as a passive investor.
Thank you.
But that's, caveat that with saying might have taken a lot longer for me to end up on the beach, because as the manager in those deals, obviously when the deal goes full cycle and the investors get a significantly high rate of return, I then get a percentage of the profits for doing a good job. That's literally how I got paid. And so, you know, a deal would do really well. And the first few deals, I didn't do any, like I didn't take any profits. It was just like, I was just needed friends to help me buy the properties. But on some of those first multifamilies, you know, they went full cycle and I earned what we call a promote. You can think of it like a success fee, saying like, if the investors do really well, then I'll get some type of fee for that. So, you know, and I was able to reinvest those fees, and that's partly why I'm here on the beach.
And so Cedric has a question. So have you been able to leverage the relationship with the REIT you worked for, or any REIT relationship?
Funny, not really. It's interesting that, and I realized that like 90, maybe 99% of employees at a REIT or a real estate fund don't actually invest in real estate themselves. Maybe they own some of the stock or like shares of REITs. They don't actually own like rental properties themselves. There's too, you know, they're too busy with their 9 to 5, their W, and you know, when they get home, most people when they get home from their day job, they don't want to do extra work, or they don't want to do what they were doing at their day job. For me, it was like I went into the day job already being passionate about real estate. So I'd come home and I would start grinding till like midnight on looking for deals and underwriting deals. I'd be daylighting at my day job looking for deals on my computer when nobody was looking, and just, you know, so the thing is, you know, most corporate employees don't really want to get involved in that. So no, I haven't really used any of the relationships there. You know, it just wasn't, it's not really the type of people that I would ask.
Mhm. So,
But a lot of my coworkers were investors in my deals.
right, you mentioned that part. So
Yeah.
at least that worked
Yeah.
or was helpful, right? So AJ has a question in terms of like cash on cash annual return on
Yeah.
your deals, let's say. I know you mentioned IRR. I've covered
Yeah,
that.
yeah, cash on cash, it depends. So multifamily, like we were always shooting for like an 8% cash on cash. Obviously, as cap rates came down and interest rates went up, the cash flow eroded to nothing. And so it was very difficult to find deals right now. You know, you could probably do 4 to 5% cash flow in year one on a multifamily deal in Arizona. And so that's part of the reason why I'm now looking for higher yield with the Airbnbs. So this Airbnb portfolio will cash flow 8 to 12% right off the bat. And so it's much higher yield. Now, with that is a little bit higher risk. You have shorter term leases. It's a, you know, a nightly rent. It's essentially a hotel. But with that risk, you get much higher yield. And some would argue that that cash flow cushion mitigates that risk to an extent. So it just depends on the asset class, the deal, the location. There's a lot of different factors that determine cash flow. I like to see, you know, 8 to 12%. So that works for me.
Mm-hmm. And so Bradley is asking, hold on, is asking like what would you do today if you're just starting, and how would you structure your first 5 deals? Now, I know you mentioned about sort of the necessity of those doing well, right? So that you can actually use the track record.
Yeah. And the best thing you can do is borrow someone else's track record and someone else's platform. So what I would do is I would probably go on like Wall Street something and learn how to underwrite. I'd watch a whole bunch of YouTube videos, become like an Excel guru, underwriting genius. And this is just me. Maybe someone else is different. I just come from a finance background. And then I would approach one of those sponsors that are putting deals together, and I'd say, hey, like, let me provide this value to your fund or your opportunity. Maybe like you don't have to like pay me up front. Maybe like if we close on the deal, you can give me a couple $1,000s of shares in the deal or something like that. And just try to get in somehow. Even if you're working for free, it's like totally worth it. So I would just say, try to like add some value to a larger fund. Don't just try to go out and do it yourself unless you're like me and you're crazy and you don't know any better. Put on a really good pair of rose-colored glasses and you know, have fun, but expect a lot of roadblocks and a lot of challenges.
Mm-hmm. And Ruby is asking, would you mind sharing the structure of your Airbnb investment deal? Say if you need to
Yeah.
withdraw your capital investment for other purposes, is there a way out?
Can you restate the question?
Well, I guess the structure of the investment deal. I mean, it's kind of.
Oh, okay. Yeah, it's so we've got an
you can
LLC.
explain it.
So the way I do it, Gold Hawk Capital, we've got an LLC. And essentially all my investors come into that LLC. That LLC that I've set up then goes out and deploys the LLC capital into opportunities. We call this fund of funds, capital pool, a club, whatever you want to call it. Essentially, we take that money within our own company, our own club, and we deploy it into opportunities. So for example, an Airbnb opportunity. And then the Airbnbs happen, they operate and they do their thing. And then cash flow comes back to our LLC and then gets distributed to the investors. And if you wanted to be more technical about like the waterfall and stuff, it depends on how much money we bring. So if you go direct to that Airbnb opportunity, the company's called TechVestor, you'll get a 50-50 profit split after you've achieved your 8% preferred return. Whereas we're going to write a larger check. We're going to write like a $2 to $5 million check for this opportunity. And because of that, we will get anywhere between 75 and 90% of the profits, depending on how much money we bring. And that's because we're able to negotiate a better profit split at the end. And that directly translates to a higher rate of return for the investors. And so obviously, you know, because I'm doing all the work to set everything up and, you know, structure the fund and deal with all the logistics, I take a fee as well. But on a net basis to the investors, you as the investors in the deal end up significantly better off than if you go directly to the deal and get your 50-50 profit split.
Mm-hmm. That makes sense. And in terms of like withdrawal, I guess like liquidity was the other part of the question. Like, is it structured like a fund where you could
yeah,
kind
it's
of
a
have
good
some liquidity to your funds, or is it more like typical
it's a good
syndications
question.
where it's a fixed time horizon?
Yeah. I think with really like any syndicated real estate investment, like prepare to have your capital locked up for the entire hold period and maybe a few years more. You know, this is a 5-year targeted hold period. So we're trying to sell within 4 to 6 years, but I would expect to have your money locked up for at least that long. Now, I'll caveat that by saying there are opportunities to get out early. And the way you're going to do that is either by selling your equity shares to someone else that within the fund, another investor or the manager, or to someone, on the secondary market to someone else, but you got to follow the rules that the SEC has put in place and do it compliantly. And then there also, there might be different types of penalties for transferring your funds as well. So I wouldn't recommend trying to get out early, but you can if you need to. I'm not sure if any lenders would accept equity shares as collateral. I don't think so. Ethan might know the answer to that, but it's unlikely. But I would expect to have your money locked up for the entire hold period while you're in it. Real estate is a long-term game. It's not a get rich quick overnight. You will get rich, but it's it's a longer term game. It's a less liquid market than the stock market, the secondary market. The transactions happen very infrequently, but because of that lack of liquidity, there is a mispricing. The intrinsic value of the assets is often different than what you can acquire the asset for and sell it for. And so there's an opportunity to make a lot of money, but it's going to take longer to do it. There will be higher transaction costs and you're going to have your money locked up. So
yeah, that makes a lot of sense. PJ, actually, I see you're still with raised hand. I'm not sure if that's, do you want to ask another question?
I just left it like that, but no more questions from my end.
Okay. Okay, so any other questions, guys? Like, we have a few more minutes. Let me see. Brandon, go ahead.
Quick question about like the vetting process. So if you're when you were talking about kind of how to start up and become an Excel guru, that type of thing, just know how to underwrite very well, and then you're looking for basically sponsors. I'm wondering like how you would go about, giving your experience, go about like vetting a GP, like who's someone that you should work for? Because obviously you don't want to go for the big funds because they already have people doing that. But I guess like how do you kind of vet your GP? How would you vet a GP in your opinion? Like which things should you look for?
Yeah, when you're starting out, anyone who will take you, because most GPs will not want to work with someone or have a partner who, you know, has no experience. So, you know, it's gonna be a smaller. You're not gonna start out with like Rise 48. Like you're gonna start out with a smaller sponsor that has maybe done like 4 or 5 deals. You know, has somewhat of a track record, but we call them an emerging sponsor. They, you know, they're new to the game, but they've done it, you know, few times. They're probably, you know, a few years in and they've got some experience. There's so many of them out there on LinkedIn, and there's so many of them. You could also do a mastermind, and I don't really recommend this because they're so expensive. You could pay for a course or a mastermind. There's a million groups out there that you can literally pay to like have those types of connections and opportunities. And there will be, you know, 50 or 60 sponsors in those group chats, emerging sponsors looking for partnerships essentially. So there's a lot of different ways to skin that cat.
So a question from AJ, if you ever do like the RRRR deals, so it's kind of like the popular bigger pocket strategy, buy, rent, rehab, refinance, repeat.
Yeah, to an extent. I've never actually done a bird deal where I extracted, you know, all of my starting capital out of it. I've actually, my company has often elected to refinance with a lower loan to value to take some risk off the table and to cash flow higher. And so, you know, we have not always been a fan of just like slapping on the most leverage you possibly can on a property. I think if I could, you know, put like a 75% loan on a property and, you know, pull all my money out, that would be my first bird deal. But those are very difficult to find and to execute. They almost don't exist.
Mm-hmm. And Ruby is asking, is lender financing for an Airbnb single family property commercial
Definitely.
lending or residential?
Oh yeah. No, you know, it's you can get both. There are a lot of different types of lenders out there. You've got anything from like agency to like, you know, Joe Schmo, who's just a private lender. You can find someone who will finance your deal. You know, it's there are a lot of small local credit unions that are very flexible with their terms, and will lend you money for, you know, a good pitch. So you just have to call a lot of different lenders. The first one is not going to lend you money on that first sixplex that I got in Orlando, Florida, in DeLand, Florida. I had to call 30 different banks to get one of them to give me a bridge loan on it. And I got very lucky that they did. So you will find the right lender. You just have to work very hard. Hire a mortgage broker to do that work for you.
Mm-hmm. Okay, so before we wrap up for today, like Elijah, what is anything else that you want to share with our audience? We covered a lot of ground. It was very inspiring for me as well.
Appreciate
I
that.
know Kristen is asking for the best way to contact you, so I don't want to. I mean, that's already on the screen, right? So it's pretty much you have your phone
add me
number.
on LinkedIn is like the best way to stay in touch. I post like 3 times a week. Usually I try to add some type of value and in the real estate sector. So contact me on LinkedIn if you are interested in finding out more information about the Airbnb thing and getting involved in that fund. Please shoot me a text. It's 802-345-2213. It's on the screen here. And I'll send you the deck for that as well. But we're looking for partners. Our fund will close on April 14th, so that's next Friday. So let me know so we can because it's going to move quickly.
Sounds good. And Kristen, the LinkedIn, I already pasted it. So here is once again. So that's Elijah's LinkedIn. And thank you guys. Elijah, appreciate it.
Thanks so much for having me on. That was awesome. And you guys are a great crowd.
Have a good night.